All right, hi, this is Jeng, and today we're going to be going through a couple things on multifamily financing. Number one, we're going to talk about what options are out there today, and then we're also going to be talking about um, what we're seeing in the market, and then how to form your sponsorship group based on these loan types. And then we're going to talk about collections data, and then I'm going to walk you through sort of where we are, sort of on the financing and economic front, and then go through a case study, and then take some Q&A. So I really appreciate everyone who put in their Q&A stuff already. It was I probably got, I don't know, 30 or 40 questions already. So if you have any questions, just put it in the chat and I will address them at the end. So let's just jump in here. All right. So you've seen this chart before, but this really shows the four loan options for multifamily financing. All right. So bank loan on the left-hand side, Freddie Mac small balance loans, Fannie Mae, and non-recourse bridge. So let's just start on the left-hand side. So bank loans, this is going to be a recourse loan. It's going to be 3 to 5 years, 20 to 25-year AM. For a lot of new investors, this is where it's going to be at the very beginning. So whether you're buying a $1 million property or even a $5 million property, a lot of people start with the bank loan. And the main thing here, and I should have maybe highlighted it, was that these minimum property occupancy is flexible, right? So that means it can be anything, right? And what we've seen is, and I talked to a lot of general partners last week, and I gave them the scenario of, look, the property's broken, you're gonna have to come in, re-tenant the property, and all three of them said that they would use bank loans. And so that, as the economy gets tougher, not everybody's 95% occupied. That might be where a lot of people go back to, is the bank loan. Second one is the Freddie Mac small balance loan. This is, your standard 5, 7, 10-year loan term. You get your 1 to 3 years interest only, 30-year AM, but they need to be 90% occupied. And we're going to talk about this a little bit later, but they used to do this for a lot of new investors as long as you have third-party property management. But now they're really focused on experienced and local investors on the Freddie Mac small balance loan. And that tops out at 7.5 million. And then Fannie is pretty much your standard for your B and C. A lot of people use Fannie Mae. So 5, 7, 10, 12-year loan terms are typical. 30-year AM, 1 to 3 years, 90% occupied for 90 days. The big thing on Fannie is that you have a yield maintenance prepay. So that yield maintenance prepay can be, it can be 10% of the loan amount when you go to sell the deal. It does have the option for assumptions and supplementals, though, on the Fannie Mae side. And then the last one is the non-recourse bridge. So this is similar to the bank loan, 3 to 5 years, but they typically want $5 million or higher on your loan amount, and then your prepay is 1%. And a lot of times your interest rate is going to be floating on the non-recourse bridge. So you'll buy a cap for it typically. So the key items, recourse versus non-recourse, almost everything except the bank loan is non-recourse. In terms of loan term, most people are trying to get out to sort of at least 5 years on their loan term. So you really have to go to Freddie Mac or Fannie Mae to get that occupancy. Fannie and Freddie need that 90%. And then the new versus the experienced, the new investors are going to be on the bank loan, Freddie Mac small balance loan, versus the experienced guys will be Fannie and non-recourse bridge. So in terms of types of multifamily investors, on the individual side, starting on the left, this guy essentially does everything. It's his own money. It's he finds the deal, he signs on the loan, and really his focus is just finding new deals. Where a lot of people that I work with are really on the general partner and limited partnership side. So the general partner does everything. The only thing that they're really not doing is putting in all of their own money, right? So they raise it from limited partners. And limited partners, their job really is finding general partners to invest with. And so a lot of people start as limited partners and then transition to general partners. And, the reason why the syndication model works so well is, let me give you an example of 100-unit deal for $5 million and, $1 million in equity, $4 million in debt. And, to qualify for that $4 million in debt, you need $4 million net worth, you need $400,000 in post-close liquidity, and you need prior multifamily experience to qualify, let's say, for Fannie Mae on this loan. And so what happens is these sponsorship groups essentially become, sort of put together. And I give this example of, let's say the sponsorship group is receiving 20% compensation for putting the deal together. So they receive, $100 comes in, they receive 20, and the limited partners who put up, let's say 100% of the money receive the other $80. And so let's start with investor one. So the investor one, he found the deal, and he's raising equity, and his net worth is $1 million and 100,000 liquid. He might receive 9% of the 20% compensation. 8% might go to the guy. Let's say he has multifamily experience. He's raising equity, $1 million net worth, and 100,000 liquidity. And then investor three, he might receive 2%. Let's say he has a good net worth and liquidity, and then he's raising equity. And then the last investor four, he'll receive 1% because of his net worth and liquidity, sort of taking them over the top, right? So they need that $4 million net worth and 400,000 in liquidity. So the most valuable things right now are finding deals and having that multifamily experience, and things that are a little bit more common in terms of the net worth and liquidity and raising equity. You're just not going to receive as much compensation. So let's jump in. So that's sort of, how people have been putting deals together. Let's really go through what collections, how the market's looking right now, and then how lenders are underwriting deals. So this was just as of the end of last week, really, of where, let's say a sample size of about 15, 20 deals that I'm in, and majority of them are actually better in May than they were in April, sort of as of the first week. And so you can see on the A stuff, we're really 90 to 95% collected. B stuff, you're 80 all the way up to 90%, just depending on, where it's located and, the quality of the tenancy in that specific property. And then your C deals are really 80 to 85% right now. And, the NMHC, they sort of tracked on the right-hand side apartments year over year and then month over month. So month over month, it's actually better in May than April. That might have been because the first couple days in April had like a Saturday and Sunday in there. So it might have been off a little bit. But May is looking just as good as April. And, they ended up, April collections ended up, north of 95% for the full month. So I think a lot of people are pretty happy with May so far. Some other collections data sort of on April. People are seeing the A stuff do well, B's right in the middle, and then C's sort of on the bottom half. But these were some of the interesting things that I saw. Major cities, smaller floor plans are getting hurt, corporate rentals are getting hurt, and then the short-term rental market. So we haven't seen this too much, but more on the larger single family houses in these tourist areas, those are getting hit significantly. And then if you thought, you were going to have a big Airbnb segment of your apartment, that probably is struggling right now. And so not only sort of looking by class, DFW and Austin, the properties I showed earlier, those are all doing pretty well. Where we're seeing a lot more hurt is sort of your tourist markets like Orlando, Las Vegas, Fort Lauderdale, and then your energy markets. So like a Houston or Oklahoma City. And then even on the coast where there's been just a larger concentration of COVID, those are getting hit more, the New Yorks and the Californias. And so this is Ken McElroy, and a lot of people follow him sort of on, he's one of Robert Kiyosaki's Rich Dad Advisors. And he put this nice chart out there, which I really liked. And it talked about sort of the timing and how sort of you dropping like a pebble in a pond and how it ripples out. And so I wanted to sort of go through these steps with you. So, we got hit with COVID-19, which is now we're seeing unemployment at, 30 plus million. We're seeing the stimulus come, the defaults are coming, bank REOs, and then, at that point, he's thinking like 12 to 24 months, there's going to be time to buy and there's going to be inflation. So I sort of wanted to take each one of these. The COVID-19, we're seeing a lot of stay-at-home orders lifted, and it's improving significantly. So hopefully we'll see that sort of trail off, and, by June, pretty much everything will be opened up and the cases will sort of flatline and start trending down. But unemployment, that has just kept raging up I mean, I think for April, we're at close to 15%. I think most people are going to see that number go even higher sort of when the May numbers come out. So it hasn't stopped yet. I mean, it's slowly trickled down from the sort of 6 million, but the unemployment rate is north of 15%. Most people see it going to 20%. Um, and then this, this is just sort of putting it into perspective compared to sort of the peaks of the last, 5, 6 recessions, how many jobs we lost in such a short, I mean, this is only a 1 month time frame, and 7% of the population has lost their job. And essentially what this has led to is the Fed saying, look, we're going to put people back to work with, or get people money. So through the PPP program, through unemployment. And so the Fed's balance sheet has really ballooned this year from, let's say, 4 trillion all the way up to 9 to 10 trillion dollars. And that could, continue to increase. And so, I want to give you some data. Fannie and Freddie put out some public data, which I thought is pretty interesting. And it's the first data point is really around forbearance. And forbearance we've talked about is really, getting 90 days to not pay your mortgage payment. And Fannie Mae put this out and they said, look, if a forbearance is related to COVID, we are going to give you some high level data. They're not giving you all the data, but here it is, which I could dig up. Was at the end of April, there was 29 loans totaling about 373 million. And then this last week, that essentially doubled in terms of number of loans, and then almost tripled in terms of the size of the loans. And so we're going to be tracking this number going forward. But I think this is majority of the people who are taking forbearance, it's sort of the last straw, right? They could not raise the capital anywhere else, and they almost have to do this to avoid foreclosure. So this is showing some of the stress that's going to be coming for Fannie Mae loans. Freddie Mac, they sort of put out this is mid-April, so I think this is going to get worse as well. They had about 327 loans. Majority of those loans were actually small balance loans. So their small balance book is more B and C. It is, smaller unit size. It's typically, 50 to 100 units, compared to their larger conventional loans are closer to the A and B, larger, 200, 300 unit properties. So only 0.5% of their loans on the conventional side were in forbearance, whereas about 3% of the small balance loans were in forbearance. And this is, so I want to give you some favorable stats for, being glad that you're in multifamily. So here's CMBS, and this is special servicing, essentially, guys who didn't make their payment in April. And the red line here is hospitality or hotels. You can see it go from 1% up to 20% in 1 month. You can see retail going from, 1% all the way up to 10%. A small spike in multifamily, maybe from 3% to 4%, maybe 5%. And then industrial went up a little bit. And so, that in terms of retail and hospitality, there definitely is a lot of work to be done in that space. And I found this actually really interesting is one of the data providers puts out sort of the largest loan losses. And these are deals that basically have already broken, right? So they went into forbearance, couldn't come out, went to special servicing, and they essentially had to sell all these deals. The lender had to sell these deals at a loss. And I broke it down by category: hotels, office, retail. Those were the huge losses that these guys were taking. And it, really came down to losing maybe one tenant or two tenants. And once you lose that anchor tenant, it just, snowballs across the rest of your center. And like some of these malls at the bottom, what you don't see in retail, which is nice in multifamily, is if you lose your anchor tenant, it triggers co-tenancy clauses, which allows all the other retailers to basically back out of your project and end their lease. And so luckily we don't have that with multifamily, and we have a diversified income stream. So I guess I just want to show you guys this to say why we like multifamily. And so now this comes from Real Capital Analytics. And when you're thinking about when is the right time to buy, and when to really get back into the market. Real Capital Analytics put this together from the 08, 09 downturn. And you can really see that we're probably right here, sort of in this front part of the shock and triage as we're going down. And, the forbearances really haven't picked up yet, right? It's been pretty small, and the foreclosures really haven't happened. So I think as in the next 6 to 12 months, we're going to ramp up onto this new distress, and there's going to be a lot of workouts, and, prices are going to be discovered and then slowly come back out once a lot of these workouts and resolutions come through. Um, so my hope is that this Real Capital Analytics slide is really across all property types. They really see hotel, retail, senior housing get in a lot of trouble, especially in dense cities. But hopefully, apartments look like this, but just a little bit shallower and a little bit quicker. And so that's the hope on the multi side. And then, a couple of reasons why it's going to be time to buy is when you're looking at the spread between 10-year treasury and the multifamily cap rates, it's at its highest ever right now. So, 10-year treasury is at, let's say, 0.7. And then, let's say multifamily cap rates are at 5.5. So about 477 basis points. And if you go back to 06, 07, 08, that spread was only about 150 basis points. And so, I think there's a lot of room in between those in terms of what other investments can people invest in right now compared to the risk-free rate. And here's a projected forecast for Q2. So negative GDP, 20%, even 30% negative in Q2. And then they expect a big rebound in Q3 and then sort of back out positive. I think that's a little bit aggressive. I think it might take a couple more quarters to get back to positive GDP. But that's what Moody's is projecting on their end. And then, once you get back through this sort of time to buy, it's all about inflation at that point. And it's been hard to really see a ton of inflation the past couple years. And, a lot of people are trying to think, all right, with all this debt that people are inflecting into the market or inputting and the amount of stimulus, a lot of people are seeing inflation coming up maybe 2 years from now. But I mean, I think for multifamily owners, it's great getting sort of fixed rate debt and then paying it back over time and your rent's raising along with inflation. And so here's another slide that Ken McElroy mentioned, just sort of when the dollar was taken off the gold standard back in the 1970s. You could see, essentially flat at 10 cents for a can of soup. And then right now, I mean, it's about 85 cents for the same can of soup. And I think the way that we're printing money, it's going to continually go up in terms of inflation. And so in terms of debt, quarter over quarter, Q1 was down about 20% on the agency side. This is Fannie and Freddie. And then right now, loans, about 85% of the loans are refinance loans that are being quoted. And so let's talk about Fannie and Freddie. So on the forbearance side, really you get 90 days for your cash reserves or to build your cash reserves because you don't have to make your mortgage payment. But the negatives are you can't evict anyone. You have to pay it back within 12 months, and you're not going to be able to go get a new loan from Fannie or Freddie. And they're going to sweep all of your excess cash really during that time frame. And you have to work with any tenants during that time as well. So you're not going to be able to charge any late charges or anything like that while you're in forbearance. And then in terms of new loans, so I added some detail here on new loans for Fannie. So loans over 6 million, 12 months P&I, taxes, insurance, replacement reserves. If you do go to a lower LTV, so a tier 3, 135 debt service, you only do 6 months. And then tier 4, 155 debt service, 55% LTV, there's no reserves. On the below 6 million, it is 18 months P&I and then 12 months of taxes, insurance, and replacement reserves. And then those are released after 2 consecutive quarters of 125. And it's a minimum of 12 months. So you have to wait the first 6 months and then look at 2 consecutive quarters. Similar tier 3, tier 4, where we're seeing, so assumptions don't require any additional interest reserves. But supplemental loans, they're going to add the assumption plus the supplemental to figure out what box you're in. And then you have to put up those reserves. And then on Fannie, you cannot early rate lock. So essentially, you're going to be rate locking the week you close. They're not doing any early rate locks. On the Freddie Mac small balance side, interest reserves, 12 months of P&I, even if you do get IO, and they are requiring tax and insurance escrows. But you do not, so let's say on insurance, you typically pay the full year, year one at close, and in taxes, you might escrow 2 to 3 months. And then the release provision is a little different. So they want federal, state, and local, all their sort of stay-at-home emergency declarations lifted. And then you have to meet occupancy of at least 80% for 3 months. And then you have to meet your minimum debt service coverage hurdle. So if you signed up the loan at 130, you need to meet 130. So that one has a little bit more ambiguity, but it could be released faster than the 12 months. In terms of markets of concern, Freddie is pre-screening anything in Houston, New Orleans, Orlando, Las Vegas, Oklahoma, and they're going to put higher debt service and lower LTVs. And then we used to be able to get exceptions for things like non-local borrowers or first-time sponsors, but they are being very strict on those, if not even offering those exceptions. You're going to need very strong mitigants like a super high net worth and liquidity, great third-party property management. You're going to need something there to really get around that. Refinances, they're having higher debt service coverage, lower LTV. Same on assumptions. They're not requiring any additional interest reserves. And then they just started this. So they're looking at let's say you get under contract on a deal and then you go to submit it. They're going to look at T3 collections versus T1. If there's a drop of more than 10% on your collections in T1, they will annualize that T1 number. And so if you have not done that calculation, that essentially crushes your net rental in your underwritten NOI. And so that will be very detrimental to your loan proceeds. And they are going to be looking at collections. So depending on when you submit it, they're going to look at your collections. The first 15 days, they're going to look at the previous month. But if it's the back half of the month, they're going to look at that current month. And so just be prepared and get your data in as soon as possible on those Freddie Mac small balance loans. And so I want to go through a case study really quick on a deal. So this deal was listed 52 units in Waxahachie, which is sort of south of Dallas. And, the whisper price is about 4.4 million. And I wanted to talk about sort of how we looked at it from the debt side. So 4.4 million. And if you look at it from a Fannie perspective, it's getting to that $3.5 million loan amount, 1 to 3 years interest only. The rate's about 3.5% on yield maintenance, about 4% on step down. But because it's below 6 million, like we talked about, the interest reserve is 450,000, or the total reserve is 450,000. So that's 18 months of P&I, 12 months taxes, insurance, and replacement reserve. Whereas if you go Freddie small balance, similar loan amount because it's based on 125 debt service. The rates right now in Freddie are about 4 to 425. And then the interest reserve is 12 months of P&I, so 209,000. So on this one, I mean, looking at them, you get a little bit lower rate on Fannie, but it's gonna float until you actually lock the rate. And so on this one, I'd probably just do like a Freddie small balance and do 12 months of interest reserve on it. So here's just a little update on rates. Fannie rates are super low right now. This is on deals over 6 million. And, on a 10-year, you're at 3.19%. Freddie SBL, you're closer to 4 to 4.25% in most markets. And so that was it on the multifamily financing side. I appreciate everybody jumping on, and I'll get into a little Q&A. But my background is really in underwriting and origination of loans and investing in loans investing in properties across Texas. So definitely, if you want to set up time for me, here's my contact information, and you can reach out to me either via email or phone number. And I wanted to jump into some questions here. So if you guys have questions, definitely put it into the chat and I will address them. But I got probably 20 plus questions before the webinar even started. So let me let me just start jumping into those while people are putting in questions. Um, so Michael S asks, is seller financing available? Um, so there's really not seller financing in multifamily. The closest thing to that is really around like assuming the loan of the seller. And so we've gone through a couple of those, and those I would just forecast, if it's Fannie Mae or even Freddie Mac, just forecast doing that loan assumption and not adding a supplemental at this point. Let's see. All right. And then in terms of how to find solid investment properties, I mean, this is similar. I mean, it's going to really go back to um, listing brokers and finding the best first targeting your market, but then figuring out what your sort of strategy is around that size property, and then building that investment group around that. So forming your sponsorship team to really figure out how to go after those properties. Number three, what are the new underwriting guidelines? We went through those in terms of the reserves are the biggest thing. And then I would probably, add about, 5 basis points on your debt service coverage and 5% lower LTV. And the number four, Manuel asks, what are the loan terms and liquidity required? So I think it's really around net worth and liquidity. And so that's really going to be driven off of the loan amount. So your loan amount, net worth needs to be equal to or greater than your loan amount, and liquidity needs to be 10% of the loan amount or higher. Pradeep asks, where do you get 30-year fixed rate non-recourse? So I put this on the right-hand side in terms of pricing. And you can see that a 10-year loan is about 3.19% right now. And so you can get a 30-year term and you can get 4.26. So it's about 100 basis points higher than a 10-year. What the reason most people don't do 30 years is you have a longer yield maintenance penalty. So you have 15 years of yield maintenance. And then also, with a higher interest rate, you're not gonna qualify for such a higher loan proceeds. So that will be lower LTV. Number six, Derek asks, what are refinance opportunities for small multifamily properties? This one is really around, I would say, Freddie Mac small balance loans right now are probably your best option. You do have to put up that reserve of 12 months. And if you don't have a maturity, I would probably wait a little bit because you still have to put up 12 months of P&I right now. Number seven, Dave SS. How does a first-time multifamily sponsor approach a bank for funding in this environment? I mean, you definitely have to have sort of your ducks in a row in terms of PFS, REO schedule, T12, rent roll, and sort of put all that together in a package and be able to send that into a bank so that they know that you're qualified for the loan and that you are prepared to close it, whether it's acquisition or refinance. Number eight, Neil asks, which property class is anticipating the highest number of defaults? Right now what we're seeing is sort of your top end, sort of your, new developments, lifestyle, that is having the biggest struggle in terms of leasing velocity has slowed a lot in that space. And then the lower class, C minus deals in areas, I think it's a combination of property class and location and what economies are getting hurt the most, sort of in that tourist and energy specific areas are what's getting hit the most. Number nine, Sherry LS, what area property loan types are you seeing the most strain? We talked about area in terms of property, and then loan types. I mean, a lot of people with Fannie, Freddie loans that have maturities 5-6 years from now, they're not really seeing that much strain. They're just making their payment. They're getting their collections. I would say it's a little too early for bridge loans. Most of them were done in sort of 2018, 2019. So the last 2 years, and those will come due probably next year. And so I'm thinking we're going to see some maturity default at that point where, if you did a high LTV bridge loan, then you're going to start seeing some distress in that area. Number 10, what's the advantage, disadvantage of bridge loans there right now for new acquisitions? Advantage, you're probably going to get a little bit higher leverage. I would say you're going to close faster. So on the bridge loan side, I would say they can probably close in 30 to 45 days, whereas Fannie Freddie are probably 60 to 90 days. Um, the disadvantage of bridge loans is most of them are only going to put out money for 3 years, and you're going to have a maturity 3 years from now. And if the market is soft and you can't turn around your deal fast enough, they might not refinance you, or you might not be able to get a refinance. And so you have risk of losing capital at that point, or having to put more money into the deal to get it refinanced. Number 11, Isaac asks how to factor refinance into underwriting scenario. I mean, a lot of these people, I guess I'll take a couple of these is, a lot of times you're having to put, let's say you do a loan assumption at 60% loan to value, then you're putting 40% equity. And you don't want to do a supplemental right now because the large interest reserves and real estate tax and insurance reserves. And so I would do a refinance, reset the loan, maybe 2 years, 2.5 years from now. And then, at that point, return capital, but factor in that larger loan payment as the loan dollars increases. I would increase that. So, and then if you just do a supplemental, it'd be the same thing, right? So you're going to reduce your equity in the deal, but then increase your loan amount and debt service at that point. Let's see. So this question I thought was a little bit broader is how do I I'm new to multifamily. How do I overcome obstacles? So it was pretty broad, Alex S. So I wanted to sort of take it from a couple different points of view. Um, Individual investor, I would say really start with your PFS, determine the size of property that you want to go after and that you can qualify for, right? So you need the down payment, you need the net worth and liquidity. Um, Start there, right? And then number two is start choosing your market, start meeting listing brokers, property management companies, and then start underwriting deals and making offers. And general partner, it's a little different, right? So you complete your PFS, you determine, all right, how much can I buy on my own? And then you really have to start looking at forming your sponsorship group. So who's going to fill out the multifamily experience? Who's going to determine the net worth and liquidity? All those things, and then start going out and looking at deals, meet listing brokers and property management companies. And then you have a fourth step, which is you have to build a database of investors who can invest anywhere from 50 to 100,000 into your deal. And I'd probably, if you think you need only 20 people, I'd probably double that right now. Especially the market's been okay in terms of the stock market, but if there's another big downturn, I think people are going to feel even more nervous about putting that much money into a deal. So I would have a bigger database of investors, start underwriting deals, making offers, raise the equity, and then close. And then limited partners, I would meet as many general partners as you can, start getting on their distribution list, research their track record, and then start underwriting deals that they've sent you, and reviewing their webinars. And if you like everything that they tell you, then send in your money on that from investment standpoint. All right. So I think I got all the questions. So I will send this out to everybody who's registered for the call. And if you have anywhere else or any other questions, feel free to reach out to me. Let me throw up my contact information right here. Reach out to me, email. You can see all my loan closings at txmultifamily.com. And then definitely check out the YouTube channel where there's a bunch of information on everything from multifamily financing and investing. And appreciate everyone joining the call today.